I'm Keegan Caldwell. I'm the managing member and founder of Caldwell Intellectual Property Law. And tonight we're going to be talking about the value of IP and raising capital with patents as collateral. A topic that there's been a great deal of interest about, especially recently, is there's some new options for doing something like this that have been very uncommon in the past. Not completely unheard of, but uncommon, and now more widely available. And so tonight I look forward to speaking with the panelists, getting a couple varied perspectives on their experience with fundraising in general and their experience with using patents as collateral for debt funding as well. So that's enough for me. I'll go ahead and let our panels take a second to introduce themselves. Chad, do you want to tell us a little bit about yourself?
Sure. Thanks for having me, Keegan. Thanks for the E-Forum for hosting this. I'm Chad Willardson, founder and president of Pacific Capital, based in Southern California. This is as dressed up as I get. I asked Keegan if I had to wear pants, and he said yes. So, yeah, I'm involved in a lot of different companies, a co-founder of a fintech company called Gravy Stack, but I'm here representing, I guess, more or less the investment community as someone who is a fiduciary and manages a lot of money for entrepreneurs around the world. And so, I'm happy to be here. Thank you.
Aaron, you want to go ahead? Thanks, Chad.
Yep, Aaron Stewart, co-founder and chief visionary officer, or I'd like to say chief nerd of job.com. Been in recruitment tech my whole career, which is about 15 years. I guess, I have a deep passion about utilizing emerging technology, and, the mission of our business is to help as many people feed their families and pay their bills as possible. So it's a real world use case, and utilizing technology to remove as much friction out of that process as possible. And I guess that's my underlying passion and drive for what I do. And I'm very, very honored and privileged to be here today. And I'm really looking forward to providing value to you all and giving you the perspective that I have on the topic at hand.
Great. Thanks, Aaron. Go ahead, Jeff.
First off, I can't follow that accent, so.
We won't hold it against you.
I'm happy to be here. I appreciate the E-Forum, Keegan. Thanks for the invitation. My name is Jeff Polk. I'm a senior vice president at Aon. I'm based in Philadelphia, but we have clients obviously throughout the country and throughout the world. Aon is probably the largest insurance broker in the world. We broker about $75 billion of property and casualty. We also have solutions in wealth. We have solutions in health, and we have solutions in reinsurance. Intellectual property is something that we're really big on. We have an IP team of about 180 people. I sit outside of that IP team. I spend about 50% of my time working with our IP team. I'm really excited to be here today to talk about the solutions in IP and what we call collateral protection insurance, which is our debt facility.
Yep. And then due to some unfortunate circumstances of COVID and nanny scheduling, one of our panelists is joining us remotely. Christian, can you go ahead and take a minute to introduce yourself?
Yeah, sure. Can you guys hear me all right?
Yeah, we can. Yeah.
Awesome. This is weird. I've TA'd class in this room here.
It's super weird.
But,
yeah. Go ahead.
Okay. So thanks, Keegan, for the invite for this panel. My name is Christian Wentz. I'm the founder and CEO of Gradient. We're a next-gen cybersecurity company born out of technology that actually was invented in the building you guys are in. I think you're in the data center now. Mm-hmm. Yeah. So, we have a sizable IP position to defend that innovation. And so I think part of the conversation here is how are we leveraging that for fundraising purposes and for growing the business. Looking forward to a great discussion.
Thanks, Christian. I'd also add that Christian is the only person that went to school here on our panel, too. We tried to squeeze one in. We could only get him remotely. Anyways, so the name of the panel is titled The Value of IP Raising Capital with Patents as Collateral. The general structure is that we're going to just learn kind of some high-level points about the program. We're going to learn a little bit about our entrepreneurs' path to where it is that they are now, both with their IP and their capital raises. And we're going to learn a little bit about a third-party perspective on the value of each of those fundraising options and how this kind of fits into everything. And then towards the end, then we're going to talk about the very specifics of the collateral protection insurance program offered by Aon. So without any more further ado, Jeff, why don't you go ahead and give us a 30,000-foot view of the CPI program, how it came to be, and you've already told us how big the team is, so it's very robust, but it's fairly new, I know that. So could you tell us a bit more about that?
Sure. So about 4 years ago, we purchased a firm called 601 West, which had some very unique IP talent. From there, we built out an IP solutions team. Like you said, Keegan, it's pretty big today. And so there's been a pretty interesting transition over the past 3 or 4 decades when you talk about the value of companies. About 40 years ago, 80% of value in companies was made up of tangible physical assets, right? Today, that's shifted, right? Almost 85% of companies today, particularly in the S&P 500, is made up of intangible assets, right? Patents, trademarks, other intangibles, right? So there was really no really great opportunity for high growth, IP-rich companies to raise debt, right? So we wanted to provide a solution, almost mimic, an asset-backed loan, right? So with the addition of 601 West and that unique talent, we built up a team, and then we educated the markets on the insurance markets, on can we transfer this risk if we can help collateralize IP, right? And so what we essentially do is we're able to do a comprehensive valuation of a company's IP. Based on that valuation, we're actually able to facilitate debt and obviously collateralize those IP assets. So we've done about 15 deals to date, and we're growing. We have a fund, an internal fund. We've raised about $500 million, and then we work with pretty big name external lenders who also offer debt for these deals. So we're happy to be in the space. High level, hope that's high enough.
And how long has this program been around, and do you know of any that are similar to it existing right now?
Sure. So the program's been around, I would say about 3 years, almost 3 years. I think there are some similar programs, but none backed by an insurance broker of our size, if that makes sense. And then none of those solutions have insurance. There's no insurance wrap behind them, if that makes sense, right? So our insurance wrap basically insures up to 90% of the loan, which I think is why it's an appealing option for not only borrowers and lenders.
Yeah, I think so. And traditionally what I've seen as well is it's been focused, any IP-backed lending has been focused more on device manufacturers, like where maybe an Apple, Samsung, Qualcomm, someone like that had to be an infringer in order to get any sort of sizable debt-backed loan. And again, there was no insurance piece to any of that. So definitely an exciting new product. All right, so Chad, maybe you can take a minute and tell us about how this fits into the greater scheme of capital for startups. When we start thinking about when we're weighing VC options, hybrid debt, venture debt, and equity capital for a successful startup, how does a pure debt solution like this CPI program maybe fit into all that, at least from like a high level philosophical perspective?
Yeah, I think it's interesting because as founders, you're looking at that high growth situation that Jeff was talking about, and how do we raise money? And it is expensive. A lot of the equity dilution that we see, I think especially if we're talking about 2022, where we are right now, where the economy is slowing down and perceived risk or risk is increasing, it becomes a lot more expensive to raise capital. And so it's difficult, as Jeff said, for these companies, these startups, to go out and get a straight debt, debt approval at this early phase of the game. So some of the founders that we have referred through this program, it's just been a magnificent situation where they can actually, I think the first step though is creating and valuing the IP. And that's something that we're skipping over as if it's obvious, but
yeah.
We've had multiple clients sell a business and go through an exit and not even have some kind of IP built into their business valuation, which really kind of shortchange the amount of value they got on the sale. So I think step one is really helping these founders recognize the IP that they have within the business, have a team that actually goes out and gets those patents and trademarks approved, and then having the valuation, which then leads to the opportunity of having a debt situation like Jeff's talking about. Founders are going out and getting, let's say you're getting a $50 million raise and maybe it's a 20 to 30% dilution. That's expensive. And you don't know the growth of the company that you're aiming to build, but being able to have a situation where you're capitalizing your IP, your ideas, and having the debt come directly off of that asset, I think as an investor, it gives more credibility and strength to the investor to see that you've got those assets actually valued by a third party and also insured. So it's a significant thing that I wasn't aware of a couple years ago. We've probably filled up the calendar of the gentlemen on this panel because we've really tried to get all of our entrepreneurial clients in this program just because we see it as a great opportunity. I think, as Keegan mentioned though, versus giving up equity, having the opportunity to finance some of that growth through debt without giving up equity is very significant. That's not to say that that's the only route. Most of the companies that we're working with do give up equity as they're fundraising and growing, things like that, but certainly having a balanced approach is extremely appropriate.
Yeah, great. Thanks for that. Actually, I want to switch now, and maybe I'll go ahead and switch to Christian. Christian, maybe you can tell us a little bit about, you've been part of multiple startups and exits. With Gradient, where exactly are you guys at right now as a company? Because I think that provides a valuable perspective for members of the audience that might be interested in something like this. So how is it that you've kind of arrived to where you are now? What stage of fundraising are you at and considering? And then how does this fit in? How does this fit into that?
Sure. Yeah. So we are actually just turned 4. Company raised about $10 million to date. We are raising, multiples of that right now. We have revenue, couple million in revenue this year, looking to do around 15 to 20 next year, and off to the races from there. So I think we're to Jeff's point, we're early by any definition of debt-backed. Debt is not typically a significant portion of the fundraise at the stage of the company we're at. There's stuff like venture debt, which I think we'll get into a little bit here, but this is atypical of in terms of the amounts of money that are available. We are a little bit unique in that we've filed far more patents than I would guess most Series A companies have. So pre-Series A rather. For example, we've done. I think we have 15 issued families and more than 50 pending. So we've been pretty aggressive on defending our IP position. That's in part because of the space we're in is, the incumbents are massive. And so we felt that we needed to be pretty proactive about that.
And how is it that you view this option for the growth of the company like today? You see it, clearly you see it, it's something I know that you're kind of in the middle of right now. So I don't want to put you in any sort of uncomfortable position that you're uncomfortable speculating about, but how do you think that this will improve your position over the next couple of years, and why has it, become something that makes sense for Gradient?
Yeah, that's a fair question. I think the question when it comes to debt, regardless of what kind it is are you in a position to leverage it effectively? So, we're growing aggressively. We're like 30 people or so now, looking to more than quadruple that in the next 12 months. So we have significant capital needs. We have customers that were existing customers signed on that we know will scale from pilot to production. And so I think in debt versus equity, there's that trade-off of equity makes sense if you're in highly uncertain environments generally, if you're not quite sure when you anticipate seeing any revenue. Debt, obviously you don't want to take on debt without knowing that there's a reasonable probability of repaying it. Obviously that's like in and of itself a topic that I don't know if we'll get to today, but so if you have the forecasted revenue to service the debt, it becomes, I think, quite exciting because to Chad's point, equity-based fundraising is very expensive. I mean, you don't buy back those shares as an early stage company, right? So, 10, 20, 30% dilution in a round is huge amounts of capital, particularly as you grow the business. It only increases in size versus a debt vehicle, provided you can service the debt, cost of capital may look kind of expensive, but on the whole, you retain more of the ownership of the business, which is where most of the value probably resides if you've done it right.
Jeff, Christian brings up a great point about timing for companies, and this is an impromptu question for you, but what do you think is like the ideal timing for Aon taking a look at companies, and where's the sweet spot for what you guys are looking for?
Great. So, I would say that we're not looking at traditional startups, right? Most of our companies have raised some equity, right? You can usually recognize somebody, somebody who's given equity, right? It's usually a recognizable name in the space. And that's obviously attractive for us because we want to know why they were attracted to the company in the first place, which is usually exclusive of the IP. These are also companies that, need runway capital, right? And they're going to use it for commercialization. So this isn't funding for marketing or R&D, right? These are groups that are already in the market, similar to Christian's company, already have some revenue and are looking to really take the next big jump, if that makes sense.
Great, thanks, Jeff. Aaron, I would just jump to you now and ask you about the same of what I asked Christian to give, because the background of job.com is different and a bit more evolved or later stage than Gradient is. Can you give us a little bit of background about the company and how you've arrived at where you're at and your experience with IP up to this point?
Sure. So job.com, we're about 140 million revenue, around about 10% EBITDA, so 14 million EBITDA. We have achieved that through acquisitions. We have rolled up cash flow positive businesses. The business model is effectively buy traditional recruitment staffing agencies and then digitalize and layer in our technology and our platform with it. This has proven a very successful route for us when it comes to growth and entering markets and gaining clients. We reside in what we call the HR tech industry, human resource technology industry. The HR tech industry is a deeply unpatented industry. I can name drop in companies that are out there like that we all know, like Indeed.com. Right? We're all familiar with them, right? I think they lay claim to about one patent. It's an 8 billion revenue company that has vast amounts of intellectual property within their platform. But for some reason, our industry has been somewhat asleep at the wheel. I think that we were a victim of that too, up until about a year and a half ago, so when we sort of joined Keegan and Caldwell, and began to aggressively patent all of our methods, etc. We've done about 45 so far. We have about 15 pending. We have a whole array of concepts and ideas that we've done in our sort of harvesting sessions, and we look to continue to aggressively patent out all of our methods and apparatus. When it comes to funding, so we have raised about 55 million so far. That is actual dollars that have come into job.com. We had two roads to choose. We're in a position where we can service debt because obviously, we are a profitable business. And as we have all, concluded that, another equity round comes at such a great cost potentially, when really if you have, good serviceable debt, and it doesn't, put the business under too much cash flow pressure, and the structure of the deals that we have in front of us based on this IP-backed lending is very, very favorable. But also, It is also, it doesn't put too much, like a debt to EBITDA ratio, doesn't make the business look unattractive for any further investment at a later point as well, which is also something that you must take into account. I think it represents an opportunity in our industry to realize capital where we just wouldn't have realized it before. It also allows us to realize balance sheet asset value that we wouldn't have realized before and start to truly capitalize on all the things that we do, because we've gone from human capital industry to tech augmented human capital. And by doing that means that we have a huge amount of intangible assets that now have huge value that up until this point, most of the competitive landscape in our industry has done nothing with. So it certainly presents a huge opportunity for us as a business to accelerate our growth much more strategically than the incumbents.
That brings up another impromptu question that I have for Jeff that I think folks will be
A
interested
lot of
in.
impromptu questions here.
I've planned this, Jeff, just so that I only ask you questions that weren't scripted. But for the benefit of the audience, what is the, are there restrictions on what you can use the debt for?
Yeah, I mean, one of the main questions, and I touched on it a little bit, but I'll touch on it some more. I think it has to be used to scale the business for commercialization, right? I mean, R&D, marketing, other needs. I'm not going to say it's an absolute no, but that's not what this debt is to be used for, right? These are also clients or businesses that have significant contracts on the table that if they were able to get this capital, they can fulfill that contract, right? So again, that's a big part of kind of that due diligence process in regard to where these companies are at and what will they do over the next 3 years if they get access to this capital.
And Aaron, I actually might circle back to you a little bit too, just for clarity. So when was Job.com founded?
We were founded in 2011, but we were actually founded as a business called My Job Matcher. But Job.com itself was a trading job board here in the United States. It was one of the largest during the 2000s. It was founded in 1998, but myself and my company, we acquired Job.com in 2017. For obvious reasons with a URL such as Job.com, we chose to rebrand the parent company to Job.com. So that's, because a lot of people are like, how on earth did you get hold of that domain? Like, when did you do this? And I'm like, well, there's a story, and that's the 10,000 foot to it. So.
Yeah. It's a decent story.
Yeah.
I've heard it. Grab him after. So, how does, what sort of worries do you have? And I'll ask you and Christian this, and actually I may even ask all of the panelists. Feel free to weigh in if someone wants to jump in. Actually, how do you see this fitting or affecting any future fundraising for company? For your company, or Jeff, things that you've seen, or Chad, do you anticipate there being any negative effects? After taking a large debt note, and needing to service that, will that be seen in a negative light, or do you think that having the high valuation of the IP will put it in more of a positive light? We haven't really spoken about the numbers yet and the sort of the size of the loans, which I guess we can attack maybe in this, the answer of this also. Actually, maybe we'll start there. Jeff, what's the sweet spot for you guys in the size of these, and how does that general structure work?
Yeah, so these are 3 to 4 year terms, average loan. I say the sweet spot is probably 30 to 50 million. I'd say the floor is probably 20, 25, and we've done loans as big as 150 million. So we have the capacity to do a $100+ million loan. Obviously, that is contingent on the IP. There has to be significant IP there. And just briefly, these loans are based on a 50% or less LTV, right? So if you want to raise $100 million, your IP has to be worth an evaluation, north of 200, right? So it's a very simple process. But yeah, the capacity to do a $100 million loan, I think is great for us, because when we first started this process, we didn't think the insurance carriers would ever wrap their minds around that big of a loan, right? And now we're there, and we're actively looking for those type of deals.
I'm curious about the process of valuing the IP.
Yeah, it's a secret sauce, man.
He'll never tell.
The people want to hear it.
Also,
we all
also
wanna hear it.
unscripted. Yeah.
Well, how about I give you a little bit about the overall process?
Yeah, go ahead. That
Um,
sounds good. Yep.
So overall process, after a couple of introduction calls, we do what's called a phase 0 assessment, right? Which is a high level assessment of the IP. That really kind of gives us, our IP team assesses the financials, your current IP, the current IP strategy, some other things, almost like a traditional VC would. And they come back quickly and say, look, we think this is a great candidate. We actually think the IP is above average for the loan that they're looking for. Or you know what, we have more questions. Let's just say they're above average. We make a few lender introductions. They have calls. They talk about the IP. The lender, of course, gets to know the business, the IP. They talk about the loan size. And then hopefully shortly after that, a term sheet is issued. If a term sheet is agreed upon, we go through a pretty hefty due diligence and valuation process, in which that usually culminates in a 70-plus page report that pinpoints exactly how much the IP is worth. From there, we take it to the insurance markets. We present the IP valuation. The insurance carriers meet the lenders. They have several questions. There's a high level of negotiation that goes on. And then hopefully, once we get past that, we're able to execute and close the loan. So I know that didn't give you the ins and outs, but that's the process.
And is there like so you think that the basement is 25? Is that what you'd say?
I think so, and that is dramatically shifted, in part to the current state of the equity markets. I think we're starting to see even more developed companies than we were seeing a year ago. But yeah, I'd say the floor is about 20, 25.
Okay.
When we started out, it was 10, but that target has dramatically moved over the past 12 to 18 months.
Well, from our side, I mean, the loan that we are going through the process with Aon is 125 million. Keegan, you asked about future raising, attractiveness, et cetera,
Yes.
et cetera. Well, I think it comes down to capital utilization and optimization, right? So at 125 million, based on our current EBITDA, that puts us well over the kind of 5 times debt to EBITDA ratio that you'd never want to be north of. Otherwise, it starts making the business look over leveraged. But that capital that we're raising is going to be put to work to buy other free-flowing cash assets. We're going to use that to buy more companies that produce EBITDA. So, and it's a drawdown. So you have the debt on the balance sheet, but the drawdown means that you're putting the capital to work in conjunction with Aon and the financier to go and buy assets, or at least in our case, to buy assets that bring us more profitability, which in essence, it's all about putting the capital to work quickly, buying assets that are impervious to negative macroeconomic factors as possible, like in healthcare and the cybersecurity industry, and also making sure that you are driving the business to profit optimization to make sure that it's all relative. There's big debt, yeah, but there's big profitability. Great, it's servicing it. So that's our strategy.
And Christian, what sort of effect is this having on your fundraising efforts? Positive, negative, indifferent?
That's a great question. I think it's a little early to tell. It's a bit of we're simultaneously raising an equity component as well. There's a bit of a delicate how do you feel about debt conversation to have with the equity investor. In general, I think investors are savvy to whatever is in the best interest of growing the business. I mean, so you can certainly position this as a catalyst for them increasing the leverage of their investment. And they just have to believe that the growth story is there to service the debt, but they wouldn't believe that they probably wouldn't be interested in the investment if they didn't think their growth was there in the first place. So I think it's generally positive. And it just becomes a question of, for example, it does drive up a bit of competitive response at times. One large investor one large investor that you probably heard of, their immediate reaction was, well, if you want more money, we can give you more money. So it's generally positive.
And because you've had some previous companies and quite a bit of experience with fundraising, and not talking about the CPI model here, what has the impact been, utilizing IP for fundraising? What sort of effect did that have on the venture capitalists that you'd speak with in the past?
Yeah, so I think it's somewhat sector dependent, and maybe to a lesser extent, but to some degree as well, regionally dependent. So, previous companies were in medtech where it was obviously a necessity. It was seen as a necessity to have at least pending IP to defend the technology. In our space, I think it's seen generally positively. So our space is cybersecurity, but we're definitely ahead of the curve in terms of amount of IP assets, given the stage we're at. We've, as well, Keegan knows in detail, we've been pretty lean in how we've established that IP position. There's I think there could be some pushback from some types of investors who aren't as familiar with IP in terms of how much money are you spending on the IP itself. But in general, I think it's been viewed positively.
Meaning they feel that you should be spending more.
Absolutely.
Yes, of course.
I would add to what Christian said in that as an investor looking at a company that's spending a lot of money on IP and building a patent portfolio, to me, looking at it as an investor or as investing for my clients, I think it becomes even more credible and something that's more favorable when you have this program where you've actually got it valued and useful. It's one thing to have a big file cabinet full of paper patents that are not being used. But I think the value in this team and what they've done for the clients that I've introduced to them is that they're building value within the company with their intellectual property and then using it to actually give liquidity and funding to the company as they're aiming for more growth towards an exit, towards an IPO, or towards some other large event. So it's one thing to have IP, it's another thing to actually use it to build value and then perhaps even gain liquidity from it to build more value. And I think it's the utilization of the IP and the utilization of the funds from the liquidity that Jeff's talking about that really makes a difference.
I'll add to that real quick. That brings up a great point, and I don't think I mentioned it, but in our assessment, one of the things we're looking for is a strong correlation between the IP assets and how you drive revenue, right? If we can't draw a straight line between the IP that you've created and how you drive revenue, then it's really hard to make this work, right? The IP has to be the nexus of the business. So if you remove the IP, you have no business. So I just want to add to that point, Jay.
That's a good point.
Yep. And as we're kind of comparing and contrasting, venture capital options versus debt options, one of the things that comes to mind for me is that typically with a venture capital deal, you're thinking of a long-term strategic partner. Maybe you are getting a lot of dilution, but you're usually, sometimes favorably gaining a board member or at least some folks that have been through this several times and they know exactly what it is that they're doing. Is Aon, see this as kind of like here's your money, good luck, we'll come find you when you default? Or is this,
You'll never find me.
Yeah, exactly. Or is this, or do you guys see this as serving as a strategic partnership where this is just the beginning of a much longer relationship?
Great lead up. No, definitely a strategic partnership, and I think that's similar to a traditional property and casualty client, right? If we have a large client, we want to grow with them. We're giving them full access to our resources. We spend a ton of money on data and analytics, so we are in this for the long run. We don't want to see them default. We don't want to see a claim, and I think as we took time to build this out, that's the relationship that we've built with our external lenders, all of whom are big names, if I share them with you, right? And they're just as strategic partners we are to the borrower. So no, Keegan, we're not, getting rid of the number. We are available, and we want to see them grow. These are 3 to 4 year terms, right? So this is real quick. We want to be with them when they exit, when they go public, whatever they do. So definitely a strategic partnership.
So is this something that people can revisit the well? Are people able to have evaluation performed on their IP, to be able to take a debt note? They accumulate some more IP over the next couple of years. They're in a different financial, an attractive financial position where they might be able to service more debt backed by that IP. Is that an option for companies doing this?
I think so. It's interesting because Aon somewhat takes a step back in between the negotiations of the borrower and the lender, right? And so, again, the lenders that we brought to the table are really big names. And many of them have said, listen, if we have to revisit this, whatever, we're willing to have that discussion, as opposed to this is kind of like one and done, we're out. So I think it depends on the borrower and the lender, but I think that's an open discussion. I know it's been an open discussion with most of the deals that I've been involved with. I'll also say, by the time we get to, if we do the phase 0 assessment, it comes back above average, we move forward. By the time the term sheet is signed and it's agreed upon, and we move to the due diligence, full-blown kind of like nuanced valuation, the phase 0 assessment is good enough to where we know that the valuation is usually going to come in above or at where we thought it was initially. So at that point, I don't want to say the deal is done, but we're definitely going down the right path, if that makes sense.
Yeah. And thinking about the different types of technology that's what's interesting to me here, because I think that what Aon has done is seen that there's a market opportunity, some white space for them to create a new financial product. And then I think what they've done is they broaden it out to several different industries, where even on our panel today, we have job.com, who, as Aaron indicated earlier, it was a wide open patent landscape, and it continues to be. I think it's something that I would compare to fintech like 10 years ago, but is now becoming a much more crowded area. And I think that HR tech is just kind of in the early stages of IP and intangible asset development. And where Christian, who very differently is in a field where there's a lot of traditional IP development in cybersecurity and kind of at the intersection of hardware and software. And so I think that for me, as a patent attorney, that it's interesting that the scope of what you're offering is not just isolated to like traditional hardware development sort of companies, but also to these other areas where we anticipate there to be great value in the intangible assets in the future, like a job.com. I just felt like that was worth pointing out. I also ask that, are there any specific areas of technology that you're more interested in than others, or what are there certain things that you have seen that stuck out over the last couple of years as you guys are seeing more and more deal flow?
Yeah, it's interesting. I mean, we've seen a lot. I would say the only industry that I think has been really tough is life sciences, simply because much of that is based on like 1 or 2 patents, right? And if this thing is great, then we could go public and everybody goes home happy and we help millions of people. If it's not, then then that's the end of the story, right? So I would say, with the exception of that, we have looked at like literally everything. Like you said, HR, cybersecurity, ag tech, other software plays. We did a razor company, right? So it has been the full gamut. If there's significant IP, if they have an IP strategy, and again, we can draw that line, that correlation between the IP portfolio and how they're driving revenue, we want to talk to them.
Did you have something you wanted to say? I can hear you moaning a little bit over there.
I was just curious, what besides life sciences, what industries are there that you're kind of not looking into? Like, what's not a good fit for this program?
I'm really trying to think, but I mean, we've looked at everything. Life sciences is the tough one because there's usually not a lot of IP there.
I think what Jeff is saying too, and I'll step in a little bit too, because I know he's not, as he noted at the beginning, he's not part of the IP team, but he works a lot with them. Yeah, exactly. But I think that what he's getting at is it's not, I don't think it's just life sciences too. I actually think it's more narrow than that. I think it's more specifically usually like pharmaceuticals specifically, maybe some medical devices, but I think that those would probably even be possible if you had a portfolio of products.
Yeah, and we just did a really nice med device company, a $35 million loan, which is public knowledge, so I'm happy to talk about it. But
Yeah, but it's more like, if you have like a small molecule drug or something like that, you've been working on for several years, and then, so you basically have one family of patents that now you're proliferating throughout the world, and that's how you're, getting the number of filings that you have, but it's really based on, one or two parent patent applications, not to get too technical, but that's more or less what you're saying.
Yep.
Yeah, okay. All right, well, let's start to talk about some of the general requirements for the CPI program then. So what are the absolute must-haves today? And I know that this is a moving target for you because it's changed even over the last 6 months, so
yeah,
everyone cut Jeff some slack if you end up talking to him 6 months from now.
because it might change tomorrow.
Yeah.
joking.
I think he just changes his mind. But I'm just teasing.
Yeah.
What are the must-haves for folks?
Yeah, I think, the first one is obviously the number of patents, right? I think 10 IP patents or 10 IP assets is probably the floor, right? With that being said, most of the clients that we've looked at have, 20, 30, 40, assets, if not over 100, right? So I think 10 is the floor. That's not to say we can't do less than 10, but there needs to be a clear strategy of how you're building out your IP, how many patents are pending, and so forth. So the number of patents.
When you're talking about 10 too, we're saying really 10 families.
Correct.
Not like, a couple different filings with several different continuations for those that are familiar with these terms. In general, they're looking for 10 plus families, and I would just add that my personal experience has been that I would imagine that you'd want to have 20 plus.
I agree. Yep. Cash flow positive, right? Doesn't have to be a lot, but we want to see something there. The projections have to make sense. A commercialization need, right? Again, I think I mentioned that earlier, right? No capital for R&D. This isn't for marketing, right? This has to be used to commercialize the product.
That's a great point too, and I was trying to get at that a little bit earlier. But notice that the capital isn't to be used for R&D, which is reflective of the stage of company that they are looking for. Generally, like post Series A, where they have some sort of minimum, they have like a product available that they've already been selling or at least testing, and so it provides a little bit more security really for Aon with deals like that.
Absolutely. I talked about it earlier, a direct correlation between the IP assets and how you're driving revenue. If we're having a hard time figuring out this magnificent IP portfolio you have and how you're driving revenue, it's going to be really hard to move forward, right? And then I think one of the last important things is whatever the request is, from an LTP perspective, it's got to be 50% or less, right? So if you're looking for a $100 million loan, the IP, our valuation needs to come back at north of $200 million, right? So I think that's important. If it's a little bit less, we have to adjust the loan, but that's been a sticking point for us up to this date.
So we've talked about the number of patents. How about revenue, company revenue?
It can be very minimal. Doesn't have to be a lot, but I think some matters. The more, better.
Something.
It doesn't have to be a lot. It could be a couple million. If we can see contracts, right? You have some contracts on the table with some significant clients. You have pending contracts on the table. Suggested that if you get this capital, you're able to fulfill those contracts. If we're able to talk to some of those folks, that's even better, right? But we're not looking for, a $20 million company. It doesn't have to be.
And so is there, like, let's just say that there's a company that has 9 different families of patents. Is that something that Aon will even look at, or is that just basically you should at least go get some more?
I think it's worth having a conversation. I'm hesitant to say no, because we have looked at some great companies that don't have a ton of IP. But I think the more IP, the better, right? And I think the IP strategy also makes sense, right? Who is internally or externally helping you drive that strategy? Do you have a strategy, or did you just buy these assets and it's a part of your company? All that makes a difference. Mm.
Yeah. How has that been part of the diligence process for you, Aaron, and how they're viewing well, we're not getting a direct answer on Chad's question for how exactly the valuation occurs. Jeff, which I don't think Jeff knows the answer for.
I do know the answer, but
Okay.
Well, then we better grab him before he leaves. So,
I tried to give him an out there.
Yeah.
He didn't take it. But what sort of what's your perspective on the diligence process and the sort of things that folks want to keep an eye out for? Any strategic considerations they might want to contemplate before they begin having those conversations, so they're not jumping the gun too soon and spoiling an opportunity that they might have otherwise.
Sure. Well, and to be fair, when you say them out loud, they kind of feel like common sense in some respects, which is like, and we touched upon it. So it's not just a bunch of outlier patents and intellectual property that have been created that have no bearing or reflection to the product, the service, the trading of the business, right? This is, you offer a service, that service has IP, that IP has been patented or patent pending, and that gives you effectively a competitive advantage. There's other factors to look at as well as market size, okay? How many incumbents are in that market? How many of those have some level of crossover or layover to what you are doing, which means that if you've now been the one that has patented those particular processes, it provides a potential opportunity of revenue, strategic, competitive advantage, et cetera, which are all, can be measured in multiple different ways. But I think you've really got to be honest with yourself of, do we have an IP and patent strategy that truly crystallizes our product and service offering, makes us more competitive in the market? We're not some tiny service offering in a market that really doesn't exist right now, and there's nowhere else to measure it. Are we in an ecosystem, a universe that has other tangible competitors in the market that we can compare, may even be more developed than us, but haven't gone to the route of intellectual property, especially in the HR tech space? And that then starts to provide quote unquote value. So.
Thanks for that, Aaron. What about, or one of the things that you keep bringing up and that Jeff's brought up also, and that Chad has, is market adoption, right? That like part of the value has to be that it's not just that you're patenting something because you think that you invented something cool.
Yeah.
And that's great. But you've developed an asset, you've developed a patent asset that you can use to leverage to accomplish your business objectives. And the way that you're doing that is you're demonstrating the value of that IP through the market opportunity that there is and the potential market adoption.
Yeah, I mean, and like, in the recruitment and staffing space, right, in the United States, this year the market will be worth $157.8 billion. There are 20,000 staffing agencies currently operating in the United States. They'll place 16 million people into work this year. Now, when you look at how that's been traditionally done through human capital, manual, etc., the technology that we've built at job.com is all around process automation of many of the low-value tasks that humans do in order to focus them on the high-value tasks. So the market adoption and the potential opportunity of this patented intellectual property and software in our industry is exponential. And that's, I think, one of the advantages we have going through the process with Aon and the bankers, because there really is, so much data to support that with the rollout of this technology. We call it tech and touch because it's technology augmenting humans. There really is a huge market in our space.
And what about the impact on future valuations? Do you think that this, the valuation that you've received from Aon will impact that positively?
Yes, and I think what it does is it provides the first stage of crystallization towards intellectual property value in HR tech. But more importantly, if that tech then truly has traction in the market, and also if that IP gets put to work, i.e. we start to prevent other competitors, or we might start taking licenses from other competitors, I forecast a huge rise in the valuation of the business or any other businesses operating in the space, because the potential is so high because of the market size.
And Christian, do you have any a varied perspective on that, or is it in line with what Aaron's is, that regarding the valuation of the IP and how that's going to be for future fundraising?
Yeah, I mean, I think it's certainly a nice lever to have, right? I mean, it depends on the economic environment. So if you asked us 6 months ago, we're in a unique segment. No one is going to stop spending money on cybersecurity, especially when Russia does the things they've been doing. So we're pretty immune to macro conditions, but I would be lying if I said that there hasn't been a slight shift in view. And so there's, different types of investors have different knee-jerk reactions to, well, here's how I think about valuing things. And so the more pieces you can have to counter that and have a more aggressive valuation, the better. I mean, so for us concretely, our technology is provided as a service generally. It might be, a complicated thing deployed to a Fortune 50, but it's still provided. We charge per month per asset essentially. And so, if you're a SaaS company, there's I think anyone following markets has seen there's almost like a step function that went back down in the last couple of months where enterprise value as a multiple of the next 12 months of revenue is like the metric for valuation. Well, among other things, we can point to things like actually our IP assets alone are worth more than that. So your multiple is cute, but we don't really care. I don't know if you should position it that way exactly, but take your own strategy. So it's definitely valuable. And I would just echo the something you guys have been talking about, which is when I was saying that there can be some pushback on earlier stage companies investing aggressively in IP. I think it's part of that is a byproduct of a lack of sophistication on the part of early stage investors to understand and appreciate what IP means. Whereas in segments like medtech, it's well understood that you defend the significant cost and time of developing the technology with IP, and things like software or largely software technologies, that's less understood. So it's sort of on you, the entrepreneur, to educate the investor sometimes on why you're spending that money. And if you can do all those things, then I think it's a net positive, as we're talking about here.
And an important topic that we haven't touched on yet is any encumbrances of IP. So Aaron and Christian, do you guys have any IP that you're licensing from other companies? Have you had to use it as collateral for other fundraising efforts? And how has that affected this debt note with Aon?
So far, we are not licensing any other IP at job.com from any other competitors, incumbents, and I think naturally that's because our market is so unpatented. I think in the not too distant future, it will become somewhat more of an arms race, because we're not alone. There are, like, if anyone's familiar in the industry, but there's a company called Eightfold AI that's been backed by SoftBank in the space, that's fairly aggressive on its patent strategy. Workday, I'm sure maybe we're familiar with Workday, they're fairly aggressive on their patent strategy. But when you consider that there are, between recruitment and then applicant tracking systems and technology platforms, there's well over 25,000 incumbents. There are probably only a handful that really have done any form of intellectual property. We are not generating any revenue ourselves out of our patents as of now. But I think it's because we're still pretty early in the day. I think that we've got some very strong parent patents. I think we need to kind of put the sons and daughters underneath that to really tighten up some of the white space on some of those areas, and then I think we will be ready to go out into the market more aggressively.
And Christian, same question to you. You don't have any encumbered IP, or you do? Are you licensing it from the university, or do you have any situations like that?
No, the only encumbrances I think we could even potentially have would be, Defense Department related rights, but those are never, some minor fraction of our IP portfolio was developed as part of development agreements with the government, so they technically have rights, but I'll defer to Jeff, but I would presume that that's not seen as an encumbrance.
I wouldn't imagine so. He's shaking his head no.
I've heard of the U.S. government
Worth a
coming in and
further
saying,
discussion.
hey, we've got
Worth
it.
a further discussion, yeah. Well, what is the, I guess, maybe we'll settle with you here, Jeff. So what is the take on any sort of encumbrances? You know, like what if you, on in licensing or out licensing, right? So I'd imagine that you guys don't have any issues with prospective companies licensing out their intellectual property that you would be providing the CPI program for. But regarding any in licensing where they're licensing things, they can't use that to as part of the valuation.
Correct. Yeah, I haven't seen that come up. I think the big thing about the IP we don't want to see is like defensive IP, if that makes sense, right? Like you're getting patents solely for defense, right? Because you think you're building this moat. Like we don't want to see that.
Yeah.
Right.
Yep. Like so, you want to be able to see it where it's there's a market strategy where you're going to leverage those to create business opportunities.
Absolutely.
Rather than just sit on them.
Correct. And that goes back to that IP strategy, right? Like I don't, it's not in any of our notes or decks, right? But I think that's an inevitable that we look for when we start getting into these deep conversations. What do you guys plan to do over the next 3, 5, 10 years with your IP? As opposed to, like you said, well, we have IP, but that's a big deal.
And I guess, Chad, you brought this a little bit up earlier, but how has, I think I know how Jeff would answer this question, but I think that, how has the current economic climate affected your, guidance of companies in the sort of investment options that they should pursue, and how they should get money in the bank, and maybe how the CPI program might be more favorable due to where we're at economically right now?
Yeah, it's kind of early to say, but I think that we can all agree that the economy is showing some signs of softening. The appetite for risk is certainly softened a little bit with what's happening in the equity markets and the economy, interest rates rising. I don't know how, I actually was curious to ask Jeff another impromptu question. But just the interest rates, I don't know, I'm not familiar with how the interest rate changes in the economy have affected the terms and rates with what you're doing in the program, and then I'll finish my answer. But
Yeah, great question. And I can probably just talk about the cost of capital too, right? So, we haven't seen a dramatic or significant impact in the cost of capital, and maybe because it's still falling in that range that we've given. But you're usually looking at a lender's rate of 9 to 14%, depending on the IP and the lender. And then you have a rate from the insurance carriers as well, which is usually 5 to 6% per annum, right? There might be some small fees in there, but you're looking at total cost of capital, maybe 15 to 20%, high teens. It just depends. We haven't seen a dramatic difference in rates from the lenders as a result of the interest rate climate. But maybe that'll change in Q4. But we haven't seen it yet.
I mean, I can't imagine. I mean, it's understandable that it wouldn't be, right? Because it's insured.
Right.
What do they care, right?
Right.
So-
And again, Aon, we don't drive the lender rate or the insurance market rate. Right. All we can do is essentially kind of prepare you for what that cost of capital will look like in the deal flow that we've seen. So.
yeah, I think with the economic climate where it is, the ability to service the debt to cash flow ratios, if it makes sense for the business to be able to take on that growth capital, then as an investor, I don't think it would be unfavorable. I think it's incredibly useful at this time to explore something like this if you've got that patent portfolio. I think it all comes down to the strength of the intellectual property assets. We referred a company recently to Keegan's firm I think they're doing, I don't know, half in Utah, $500 million or more in revenue, and they've got significant intellectual property, and they're looking towards an exit in the next couple of years. And me just hearing more about this program, thinking about the climate of raising money and the risk appetite that's out there, they might not get the valuations that they want, and they would have to give up a significant amount of their equity as the founding partners. It just makes sense to maybe balance their fundraising efforts with this program and this climate, and have somewhat of a, as Christian said earlier, a steady and predictable cost of capital through the CPI program. So I think as the risk appetite decreases in the economy, this program makes even more sense as a balanced approach to take on growth.
Yeah, if I could just interject there real quick, Keegan. We were actually just looking at this. This is the benefit of doing this virtually is I have like awesome financial models in front of me. The discount rate, if you're thinking about like discounted cash flows and net present value of an investment, a VC looks at like their discount rate is like 30 to 60%. It's huge. So inflation doesn't, I mean, anyone negotiating a term sheet with a VC right now, ask them what their discount rate is, because inflation won't factor in. But that versus like, even 20% interest rate, which sounds like a lot, is those aren't apples to apples, but just if you were to plug those two things in, the cost of capital here is significantly lower if you can service the debt, and I think that's what makes it so attractive.
Yeah, I think that's a great point. I think there's a little sticker shock on the numbers sometimes, but when you do run the numbers, you see that the cost of the capital is still significantly cheaper than a VC raise.
Especially if, like Aaron, you're using the capital to purchase assets that produce more EBITDA.
Yeah.
I mean, that's a no-brainer.
Yep. And then follow-up question there being, are the interest rates static then?
I'm sorry?
Are they static over time? Do they stay the same?
Yeah.
Or
yep.
they're variable?
They stay the same.
They stay the same?
Yep.
Okay. Yeah. Well, does anyone have any final thoughts that they want to address? I've asked basically all the questions that I have on this particular program.
I'll just say, one, appreciate the opportunity to be here today. Keegan said I owe him steak tonight, so I'm going to try to get out of that. But, we're happy to talk to anybody about their IP and kind of what we think about this process. The markets are changing. I think we'll have the ability soon to do smaller loans, right? So I know $25 million is kind of the floor that I mentioned earlier today, but I think in the very soon future, we'll be able to do smaller loans. So again, we're happy to talk to anybody. And even if the timing isn't right, we want to stay engaged and watch the companies develop, watch their IP develop, and continue that discussion. So I'm happy to connect with anybody, after tonight or a further discussion down the road. But just again, appreciate the opportunity to be here.
I have one point, which actually it's not honed in just on the fact of IP lending, but just in IP in general. I guess what I have learned as a founder of a business and in an industry that is unpatented, which is, and for anyone out there obviously that's running, growing businesses or developing levels of IP or vast levels of IP, it almost seems counterintuitive to not protect your IP and also go on the offensive out there in the market if you're truly looking to build a successful organization, future-proof your organization, and guarantee yourself more revenue generation and revenue lines in the future. Kind of, as much as you're investing into tech development, you should be investing into protecting your intellectual property. I think they kind of go hand in hand. If you are truly to exercise and portray yourself as a technology business, you kind of have to do that.
Well, it's a clear distinction, right? If you're a SaaS company that doesn't have any IP, and then you're a SaaS company that does have some IP, it seems like a no-brainer who's going to get the higher valuation, especially if you're doing the exact same thing.
Yeah, exactly.
And it's probably going to be a considerably higher valuation that you'll get a tech multiple with having it, right? And I think that's been the experience of both yourself and Christian. I think that Jeff and Chad have also seen this. Jeff, one question that I actually had meant to ask earlier that I have not is how does litigation affect any decisions by Aon and the valuations? So if there are pending patent litigations going on with prospective companies, does that negatively or positively affect the outlook?
Yeah, it's going to have a negative
Effect.
Yeah.
Okay.
So if there is pending litigation, that's, I'm not going to say it's an absolute no, but it's going to make it real tough. Yeah.
Okay. And then what about showing market adoption or evidence of use of the IP during the valuation process? Does that add more value or does that create more stress for Aon?
That's a great question. I haven't seen that come up in any of the deals I'm working on, so
Okay.
I'm not sure.
Okay. Chad, any final words?
Yeah, I was just going to say, going through this process with clients, I think some of the things that I've learned in the early stages is the process of looking at all the competitors in the space and what IP assets they have or don't have, and playing a little bit of offense of saying, what do we see coming down the road in our industry that we don't even necessarily have to be currently using, but let's go out and capture that intellectual property and put it in our portfolio. And I think Aaron was talking about that. There are large companies that have a lot of great IP that they're not capitalizing on. They haven't patented, they haven't put in their portfolios. And so some of the clients that we've taken through this process or in the early stages, we've really talked to them about not just protecting what you already do and your ideas that you've already implemented, but a lot of the things of taking advantage of what's coming down the road in their industries and being able to build that value and create an asset class that they don't currently have has been significant. And I think by the response of all the people we've talked to about it, it shows there's a lot of value.
That's a great point. And probably value for companies that are either pursuing debt or equity or no matter what their
Both.
position is, and
Yeah.
that's the advice there. Yeah.
For sure.
Christian, do you have any final words before we switch over to questions?
No, I think I'm good. Curious for the question.
Okay. Yeah, I'm looking forward to hearing some of the questions as well. Before we jump to that, though, I just want to say thanks to all the panelists, Chad, Aaron, Jeff, and Christian. I'm friends with, I have the great benefit of doing something that I'm passionate about doing, and to be able to work with people that are operating at a high level, that are brilliant minds that inspire me to be a better human being and to be a better professional at what it is that I'm doing. And each one of these guys represents that. And it's humbling for me to be able to get the opportunity to not just work with guys that I respect in that professional way, but in a personal way. And it's an honor to be friends with each of them. So thanks, guys, for joining us tonight. Really appreciate it. Okay. Let's go to
There's a lot of
the,
good questions up there.
I know, what does it say here? So one of these we have already kind of answered. It says, if approved for 50, could you come back for, I can't read that, 5 times 10 million chunks? Is that what that says?
So it's like get approved for 50. But
Actually, I think we need, can you pass the mic just so that the people on the live stream can hear? Or else I think that they'll miss out.
Yeah.
The drawdown.
Testing. Yeah, it was just a question about if you get approved for some larger lump sum, do you have to take it all on day one, or can you come back for chunks of it over a period of time?
Yeah, great question. So you can definitely come back and get it in chunks. It can be tranched out. That structure is unique to the borrower and the lender. And I've seen that structure, something similar to that proposed a couple times.
Let me see if I can see some others here. I might actually just go ahead and stand up.
It's one about the IP ownership.
My neck doesn't turn that far anymore. Curious to know what happens to IP ownership if company defaults. Who controls the underlying IP with this financing structure? That's a great question from Tony D'Angelo, the intellectual capitalist.
That's a great question. So one of the requirements in the process before closing the loan is all the IP assets have to be put in the SPV. So if there's a default or a claim, they're easily accessible. And then there's a negotiation on the period of time that can pass prior to the assets being sold or, let's say, licensed out. So that's getting into the weeds, but yeah, that's kind of how the process goes.
And another great question about priority position. I think the question is asking who has the priority lien on the IP. I think, Tony, feel free to jump in the chat if I'm asking that wrong, but go ahead, Jeff.
Yeah, the lender has a first lien on the assets, the IP assets. So there you go. I mean, and it's all IP. It's not just, it's future IP throughout the life of the loan. So it's all IP assets.
Oh, so any IP that arises after the note as well.
Correct.
Okay,
Correct.
got it. Okay. What are the ranges of value that you have seen each individual patent have, and our mature patent families a prerequisite? So let's just take these maybe one at a time. So the first one being like the ranges of a value for an individual patent. Do you have an answer for that one?
I don't.
Probably not. Yeah.
I don't. Yeah.
Yeah, but then the second question would be the ranges of value that we've seen for this is what it is a mature patent family prerequisite? And so, and this is something that hasn't come up, and so I'm going to reframe this question a bit. Is it necessary that the patents be allowed, or do they have to be issued patents? Are they going to be patent applications, some combination of that? What's your experience with that? What are the requirements?
Yeah, you got to have them, you got to have, I would say, at least 10 minimum issued.
Okay.
Right? I mean, that should be the goal. I mean, I don't want to say no, because I'm sure there's some companies with.
There's always an exception.
Right.
Yeah.
But,
right. Yeah.
You can't have 2 issued and 30 pending and say, what's up? It's got to, most of them got to be issued.
Sure.
Yeah.
Adhar?
Hi, thank you guys. I really appreciate it. Quick question around the debt and how it's structured. So some of these more mature companies have other debt lines that might be cheaper, pledged to other stuff. How do you design the program so it works while keeping those other debt pieces in mind, or it's an all or nothing kind of game for the company?
Yeah, great question. So one of the requirements, and I didn't mention it, but there needs to be very minimum, if no debt already existing, right? That has come up, I think, a few times. If it's minimum debt, I think there's no process moving forward. If they already have significant debt, it's going to be tough to get it done.
And if there's another one in room, I'll go ahead and take one now, or else I'll take one up here. Maybe I'll do that while we're transitioning. Why is litigation seen as a negative? And what makes a deal difficult? So maybe, this is from Rustin Mangum.
Well, I think litigation makes just about everything in life difficult. So, you're talking about a short-term loan, right? And if the litigation, is seen as has the ability to impact, servicing the debt, that's obviously going to impact the loan. The other thing is this, that, we're seeing so many opportunities now that, most companies don't have pending litigation, right? So that's going to be something that lenders stay away from. What was the second question?
Second question is, what's been making things difficult? What makes a deal difficult?
Great question. That we talked about that direct correlation, right, between the IP portfolio and revenue.
Yeah.
That can be a little murky sometimes, and that can make it difficult. Requesting information and for whatever reason not getting that information for whatever reason, that can make things a little difficult. There's a lot of moving parts here, right? You have the borrower, you have the lender, you have the insurance carriers, and you have Aon, who's essentially trying to broker all these people, right? So any lag in any one of those groups, including their counsels who's representing them in the negotiations in regards to the insurance contract, all that can, put a snag in the deal.
And Rustin makes just to follow up, he had one last statement or question, and that was, so are the people seeking the debt note expected to just ignore litigation opportunities? And is that just through going through the process? So like, let's say that, job.com has a bunch of infringers. Can they never, for the life of the note, be involved in any sort of litigation? Or they can be involved in litigation, they just can't use the funds from the note to do it? Or how does all that work?
Yeah, they definitely can't use the funds for that. And, we've talked about IP, or litigation funding, right? So this isn't that, but so they definitely can't use the funds for that. But I just think it depends on the litigation at hand, right? Like, are you going to war with like Apple, or is this, I mean, I think that matters, right? Like, or is this a small case?
Jeff,
that'll
is
probably go
Samsung
over.
cool?
So I don't want to
Samsung?
give the legal answer because I'm not an attorney, but it just depends on the litigation.
Everything's case by case basis.
Yeah.
Yeah. And I think that's been true. I think everyone here's experience would speak to that so far, right? Please, go ahead. What's your name,
First,
Dale?
Dale.
Dale, okay, yeah.
First, there's one comment. My attorney warned me that all successful patents are sued. So
I
that's
don't-
something I'll have to deal with.
Okay.
On the quantities of patents, does that exclude foreign filings? Like I'm going to be in 20 markets,
It does not exclude foreign files.
so they would count as the 20.
Correct.
Well, I think that I'm going to actually assist with that one a little bit. So I think that, yes, my guess is, this is a guess, okay? I do not work for Aon, I have no idea. But my guess is, based on some of the answers that I know, especially about their reasons for not wanting to get involved in like small molecule drugs or things like that, is that, so if you have a patent filing here in the United States, and then you go file it in 8 other countries, can you count those as separate filings? And my guess is that probably maybe, but it's not going to be viewed in the same light as if you had all separate filings here.
Yeah, I would say most of the companies we've looked at are, US-based companies, right? They might have an international aspect. I mean, we have colleagues in London on our IP team. We have colleagues in Asia. So, we're actually looking at companies that have significant operations abroad. So I think the answer is yes, but I think it also depends too on how much, let's say, revenue you're driving in those regions as opposed to.
Well, I'm going to be using a franchising model,
Okay.
so I want them in other countries.
Okay, interesting. I think it's definitely worth a discussion because I don't know if we've looked at any traditional franchise models, but I think we'd be open to it depending on the IP.
Yeah, great question though.
Great question.
Please.
Keegan, thanks for pulling this together. There's a lot of gray matter up there.
It's
and
wonderful to see you again.
Guys are very articulate as well, so you're probably wondering why I didn't get the answer to this question. I couldn't understand whether these loans are non-recourse or recourse loans, whether the IP is collateral as the exclusive remedy or whether it's just a sweetener. And on the upside, I wondered if these loans have equity kickers in them, and if they do you tranche those and somebody can get the equity piece, the equity tranche?
Yeah, great question. So in the past, the question has come up, can other assets be considered in the loan structure? And the answer has always been no. So it's been solely contingent on the IP assets. There are minimum warrants that are often asked about that are included in the term sheet, but they're 0 to 3%, 0 to 5%, and that's usually up to a negotiation. We usually see the borrowers push back with some success. So.
And there are equity or warrants kickers within these deals. So they typically, I can't speak for all of the deals, but there's a strike price and you kind of come to an agreement on what that strike price is in correlation to also the valuation of the intellectual property as well. But you know, the equity is a sweetener, and it is, you know, negotiable.
There's another online question here that is directed at Chad and myself. It says, can you please speak more to the importance of having an IP strategy as a foundation of a 21st century enterprise? IP seems to be just as important as a marketing strategy even today. So, Chad, do you want to go ahead and tackle that?
I think that statistic that blew me away, and I think Jeff was the one who shared it earlier, but I've heard it from Keegan before, is that the S&P 500 is nearly 85% intangible assets. And I think most investors, stock market investors, aren't aware of that. But as you dig deeper, you realize the big players in the S&P 500 recognize the value of intangible assets, and that's where they're putting the horses. Okay, so as investors, as founders, as entrepreneurs, we should be taking that as as something to really take seriously for our own companies, as to what are we doing and what's protected, what's trademarked, where's our industry going. And I think I mentioned that before, but it's significant nowadays to really have intellectual property in the information age, when everything is ideas and strategies, that we've got to actually put some teeth into that, get it valued, and have it protected, both offensively and defensively. And if we're doing it offensively, then we're looking at opportunities for liquidity and funding with this program. But all of our clients who are founders and growing, fast startups and companies that are looking to make a big transaction happen, we're counseling them to really beef up their intellectual property, because it's going to add a lot of multiple to that eventual valuation.
Yeah, and the only thing that I would add is just a statistic here, so that I don't, add my patent attorney skew to this answer. So I'll just give some statistics. The average asking price for software patents in the brokered market in 2020 was for a single patent asset was $302K, and for a family, with one or more, was $418,000. And so you can see the multiple on an investment on the brokered market, which would be generally speaking, most of them companies probably winding down or not in the most favorable position, looking to unload some of their IP to capitalize for some reason, right? And there's a significant multiple there on the investment for folks, right? So you're an early stage startup. You're thinking, I've got $10 and everything I need, every dollar that I spend, I need to be, because my venture capital people told me I need to get this much. My EBITDA multiple is going to be 15 or something like that if we sell this company. So I need to get a 15x on every dollar that I spend. This is in general, a way that can be done, right? And I would say that these are very conservative numbers. I mean, listen, 15 years ago we didn't have this sort of data, right? So there was a lot of different ways for valuing patents. There's still a lot of different ways for valuing, IP, and but the sort of data that we're able to see, at least on the brokered market, this is just aggregate data. It's not doctored or anything like that. These are publicly available sales data that we're able to see the a Gaussian curve of the median, the average, the min, and the max, and to get a good sense of what the value of the IP is, at least on the brokered market. And that provides a lot of value and confidence, I think, in investing in intangible assets, aside from the points that have already been made. So, yeah.
How do you assess the value of IP in a nascent market, or where you can see that my company, we did the first AI monitored frac in the world, to my knowledge, in 2020. And that market is still very, very junior in terms of activity that's happening there. So how would you assess a patent when there's not necessarily business or revenue being generated around something yet? Can you assess that?
Yeah, that's a great question, and I think that's probably a little more difficult than a bigger market. I know your projections play a big role in that. but I don't have the nuanced answer. You know, our valuation team, when we go through that process after the term sheet is signed and it's agreed upon, and they start doing the heavy due diligence and the valuation report, that report actually isn't shown to the borrower. It's shared with the insurance markets and the lender, right? So it's even more like, I don't want to say it's secret, and I think you can access it post closing the loan, but it's a very good question. I can definitely get you a better answer afterwards. Yeah. Especially, you know, I think that comes up. I don't think it comes up that much, but I think we have seen that where these are like new niche emerging markets and a lot of white space. So that's a really good question.
And there must be more, there's probably going to become more common because as we see, like in particular your market, Dave, like latent potential, right? And with all of this growing emerging technologies, new markets, metaverses, you know, you've got an array of growth that may not have historical or current market presence data, but nonetheless, in the not too distant future, will be major economies.
Right.
So,
Well, I think a point that's missed with David's question too, maybe, is that it's a fracking industry. This is not an industry that hasn't been around.
yeah,
This is a well-oiled industry.
no pun intended.
And that really, well, there was no pun intended. I caught myself halfway.
That's pretty sweet.
But I'm sure that it would be case by case. But you know, as we've discussed already today, but that's an industry I think that there's very clear market value, right? Like there's market adoption of those technologies. It's not something like what is, you know, someone's going to argue me after the panel or something if I say this, but it's not like, you know, talking about, you know, the value of metaverse real estate or something like that, right? Which may be speculative today, right? Aaron specifically is going to argue with me about that.
I'm very bullish on digital assets, just so we're clear.
But some people might argue that. Let me put it that way. So, but there's just less market adoption of those technologies, right? And Christian, you know, can speak to challenges of, you know, of startups that he has had as well, where he's working at, you know, sometimes he's been with startups that are at such the bleeding edge that, and I don't want to take the words out of his mouth, but I know that it's very hard to raise money for some of those things because it's hard to envision what the market adoption is going to be, and it's hard to speak with the people that have the money to explain it to them in a way that they can understand how important this is going to be and how it's going to impact things. Actually, Christian, that might even be worth you touching on for a second.
You get better at fundraising. I don't know. So the question is how do you raise capital to pursue things that are further ahead than people currently understand? Is that?
Yeah, I think I would just say, you know, I was just kind of, if you wanted to, you don't have to, but if you have anything to say with your experience of raising capital in the past, you know, dealing with technologies where there's not vast market adoption yet, and you know, how difficult some of those conversations can be, and you know, reframing that can be useful, I think, sometimes.
Yeah, I mean, I think you definitely, it's definitely harder to do than, you know, raising money for something where there's an immediate comparable that people understand. I think one strategy is to say, what is this technology good for today? And then how does that map to the, you know, you can have multiple evolutions of a technology backed by the same core IP. I would say Gradient is very much that way. You know, we talk about cybersecurity today because that's what people understand, but really we're talking about, you know, distributed trust in data, right? Like that's harder to sell. So I think the cool thing about IP is that you can build in that longevity and multiple iterations of a technology lifecycle into the first patent, if you do it right. So takes the right IP attorneys, though, I have to say.
Thanks, Christian. Appreciate it. Yeah, and there is a question up here about patent families as well. It says, how would you group the patents into one patent family or different families? I'm not exactly sure what that question is getting at, but I'll give the quick structural answer, or an easy answer is it's just, there's always the option to file these continuation patent applications after you have a patent filed, right? And that is probably all I'll say about that. So there is the option to file continuation applications after you've already filed one. And, I guess the only thing that I would add is that, that's something that you should speak to, someone that's a professional, a patent attorney about, and get some decent advice about how to strategize with building out families and what's going to have value for your particular situation, and help you achieve whatever, business goals that you have.
I just want to comment on that because I've had to file a couple of continuations that were not accepted in the first patent. In other words, they wanted it patented separately. So that's technically what a continuation is.
Yeah.
But it's still a separate patent.
Sure. Yeah, if there's not, I was trying to keep it really simple, but if there's not support, if there's not, you can file them if there's support for them in the parent application. In the first one that's filed, you can file continuations if there's support. If there's not support, they're not going to let you do it, right? One more. From Mary. Awesome. Does the inventor still have to be employed by the company?
That's a great question.
That's a good question. Never thought of that.
Didn't see that one coming.
Should be Jeff. I think Jeff has to answer.
Yeah, I mean, I'll say it certainly helps. I mean, because we brought up an example earlier, right, where somebody buys a ton of IP, right, and they do have a good handle on the IP, but they have no idea in regard to their strategy, right? And I think, but we also see traditionally where somebody buys the IP and they buy that team, right, and that person stays on for 5 years or whatever, and they continue the strategy. I haven't seen it yet where somebody who wasn't involved from day one has been asking to go through this CPI process, right? So I'm not going to say no, but it's going to be tough. It's going to be tough.
That would be tough.
Yeah, it'd be tough.
Yeah. Are there any more audience questions? All right. Well, I've got one. Okay. Oh, we got one up top. There we go. Maybe while we're going up there, I'll ask one. How should people approach getting in touch with someone about a program like this? Should they go through an investment professional, through a patent attorney, through directly to Aon? Is there any suggested course of action, or go ahead?
Yeah, I mean, you can always contact us directly, right? I think in a perfect scenario, you'd have a great IP attorney and or those resources internally who can talk to the IP strategy, what you guys are doing. You have a lot of brilliant technical founders who just can't articulate the use of the patents and kind of the nuances of their business, right? So I think approaching it with that team approach, I think is best. But we've seen it in every way. And I think we're pretty good on our side to quickly realize, okay, there's something here. We're going to send you, not a big data request, but enough information to do that phase 0 assessment I talked about. And that's where kind of our analysts and folks kind of dive in, and they can quickly come back and say, yes, there's something here, let's have more conversations. Or it's too early, or we have more questions, right? So I think if we can get to that phase 0 assessment, even if, it's just the founder by himself, and they can supply that data, we have more than enough information in that process to quickly assess the IP.
Is there a cost to do that, that initial induction with Aon?
That phase 0?
Yeah.
No cost. No cost. So there's some trust there that, we're moving through the process. Now, that phase 0 doesn't spit out a number. It just literally comes back and says, look, we think there's enough here. Let's continue the discussion. So it's not a small lift, and it's actually something that we do very quickly. Let's say you get us all the information Monday, by mid-week, by middle of the next week, that should be done. It usually is by then. So it's not a massive lift, but before we do that big due diligence, heavy evaluation, there has been extensive conversations to make sure that this is serious and this is something that they want to do.
Jeff, quick question. You had articulated a pretty negative stance against a life science company. I was just wondering if you could articulate a little bit more about that as to why and that sort of thing.
Real nice, Jeff.
So for the record,
Very negative.
I sit in Philadelphia, which is where our global life science practice is. So I know it doesn't sound like it, but I actually do a lot with life sciences outside of IP. I think, and Keegan, I think, did a good job of clarifying a little bit more, right? Like for drug companies or pharmaceuticals who have like 1 or 2 patents, that's tough, right? Because if that patent falls or something happens to that one patent, then, that's going to be an issue, right? As opposed to a company like a healthcare company or a traditional tech company that's got 45 patents, right? 15 trade secrets, another 20 pending.
Yeah.
Something happens to one of the assets, we still feel really good about the portfolio. So that's why I gave a negative outlook. I'm sorry it sounded so negative, though.
No, it's right. I just want to understand. So it's more the depth of the assets.
Yeah,
Yeah, it's
absolutely. Yeah.
if something was to be invalidated in the U.S., for instance, right? Like if let's say that the parent application you have filed in the U.S. and then you've went and filed that in 30 other jurisdictions across the world, right? Which is a fairly common strategy for life, small molecule drug companies. I'll just say that to narrow it a little bit more. I think it's a little bit broader than just that, but maybe pharmaceuticals in general, I guess is what I'll say. And so if the parent falls, it starts to cause some real value issues it's understandable that it's something that they wouldn't be as interested in because they're saying, okay, yeah, we're going to give value to all these different filings that you've had internationally, but like if the parent falls and you lose the priority date there, and then you begin to lose, you're getting invalidated in other jurisdictions as well, that value is going to deteriorate pretty quickly. Or as Jeff is saying, like, listen, if you've got, 100 trade secrets or 50 trade secrets, yet to be filed patents, you've got, 30 or 50 filed or 100 plus filed, and then you've got, a handful of issuances or something like that, you're in a much, it's a much different position. One falls, 5 of them fall, there's still value that can be extracted on the other end. I mean, they're taking a lien on the IP. They want to be able to monetize that somehow on the other end. And again, if the parent falls, like for a pharmaceutical company, then that gets very challenging. And especially realizing that there's only, this didn't come up and it gets into the weeds, but there's really only a handful of jurisdictions where there's going to be a complex damages awards anyways, right? So where they'd be able to recoup that money somehow because of the liability that the IP creates for other entities, right? So, once it kind of falls in the U.S. or falls in Europe, then it's the chances of getting a large damage award for someone that's providing a loan backed by the IP, it gets narrow pretty quick, right? And it gets then they have to start questioning why they did the program in the first place.
Yeah, with that being said, though, we're always open to have that initial conversation to see what the IP is, what you guys are doing, what's the strategy, right? So, we'd love to talk about it if you have some IP. And, I need to change my adjectives or verbs. I never want to sound that negative, but it's all good. No, thank you.
It's because we started picking on Jeff early, that's why.